And against that backdrop, I want to bring back Lesley Marks. She's Chief Investment Officer at Mackenzie Investments to talk about the tug of war, the debate, the bulls, the bears on technology names. Does it surprise you to see sort of this sort of back and forth as people are trying to figure out where we go from here? Shopify, we were talking about it before the break. It's obviously the big technology story in Canada.
I think it's really about expectations and how a company performs or reports versus expectations. There's, as a more general comment, not specific to Shopify, but expectations are quite high, particularly in some of these darling names. Shopify is like our only, one of Magnificent One. In the U.S., right. You've got the Magnificent Seven, now the Magnificent Six. Yeah. Why do we have the Magnificent Six now? Because one of the seven is showing faltering growth. And so when expectations are really high, there's a risk that when companies report or come out with their guidance for the year, that the lofty expectations will not be exceeded. And when you think about the rest of the market, and I'm not just talking about technology, but let's go with the S&P 500, the other 493 stocks where there's less focus, the expectations aren't as high. So there is opportunity there. When people think about the outlook for the S&P 500, they're very much focused on those dominant stocks because they represent such a high percentage of the market cap. But there is absolutely opportunity where people aren't as focused, expectations aren't as high, easier to beat than in the runaway expectations in some of these big tech stocks. Is
that true even within the technology sector itself?
Absolutely. And also within technology, what you have to think about is there are cyclical companies that are much more levered to the economy. And then there are more durable growth companies, companies that have a tailwind of a secular trend, artificial intelligence by way of example, that can really drive the growth of a company beyond current expectations. Companies that add to other companies' profitability, for example. If you think about in the United States right now, we didn't talk about it in the first segment, but one thing that we should talk about is productivity. Productivity has been growing in the United States. Productivity is additive to GDP growth. That's the big story in GDP growth in the United States. A lot of companies, particularly in the artificial intelligence world, are helping to add to productivity, increasing profits for many companies. So those are the companies that we expect to show durable growth and continue to perform really well.
It's kind of anecdotal, but I feel like we spend a good chunk of time talking about technology companies, maybe because that's the noise. They're always in the headlines. But if you are invested in Canada, this is not true for all, but if you were just investing in the Canadian market, we were talking about the makeup of the Canadian market before, you probably have less tech exposure than if you were invested simply in something like the S&P 500. So when you think about allocation, right? There's possibly big bucks, big rewards, maybe a little bit more volatility with technology versus other areas that you could invest. How do you think about how much exposure you should have in one's portfolio?
Such a great question, and I think it's something that every investor should think about, which is the concentration of their own portfolio. So if your whole portfolio is in the S&P 500, you're thinking, wow, I've done so well, go with the thing that's been working. But again, if that's index related or passive related, you've got this very big exposure where there's high expectations. And one thing that we've been looking at is the expectations for earnings growth in the Magnificent Seven companies versus the 493 companies. And that's been a big differentiation. So call it, 30% earnings growth versus 10% earnings growth. As we move through the rest of this year, that gap starts to close. And so the relative value or momentum in those top stocks starts to wane versus the rest of the market. So, we think diversification is always the only free lunch left in investing, but that continues to be, no more true than today. Today, that is really important for an investor to think about. You asked about Canada versus the U.S. Of course, Canada offers diversification because we have much different exposure.
All right, great stuff, Lesley.